My name is Kirk Marley with Dovetail Planning, and what I'm rendering here is not tax advice, but wanted to explain in general a concept of stepped up cost basis. So this comes into play oftentimes when we're talking about succession planning, because when you have a business interest or an asset, you can, there's three ways to transfer it. You can sell the asset while you're alive, you can give the asset while you're alive, or the asset can be inherited by your heirs. And each way that that transition happens is taxed differently. And so what I want to focus on maybe is the aspect of the tax ramifications when you give a gift versus the tax ramifications when you leave that asset into a revocable living trust, and then that asset is transferred via the trust. When you give a gift, it is important to remember that the basis in that gift, which means what you paid for that gift, is going to follow to the beneficiary of that gift. So let's say, for example, you have a home that you bought for $100,000, and it's appreciated to $250,000. It's not an asset that you need. You realize your son could use that asset, so you give him the home. And then let's say a year later he turns around and sells the home. There was no appreciation on it, but so he sells it for $250,000, which was the value of the gift when he received it. But his long-term capital gain exposure is the difference between what the father paid for, which is the $100,000, and what he sold it for, which is the $250,000. So he's going to be exposed to the long-term capital gain on that $150,000. Let's say on a different scenario, the father retains that asset and keeps it in his living trust, and it's owned by the living trust. And so when he passes away, the trustee has instructions to transfer the title of that asset to his son. And so his son then, in the same scenario, a year later, he's on title to that asset, and he goes and turns around and sells that asset because he doesn't have a use for it. His exposure in long-term capital gain is now zero as long as he sells it for the same value that it had, fair market value, at the date of his father's death, because he gets what is called a stepped up cost basis on the value of that asset. And so that actually comes into play when you're talking about a business interest, you're talking about shares of stock. Stepped up cost basis is very important when you consider your living gifting versus your gifting at death. Because what you're doing, living gifts make sense many times, but you have to keep in mind that whatever you give while you're alive is going to have the original basis, your original cost basis, and it's going to continue with the beneficiary of that gift. And so this is a really important aspect when you're talking about also business succession planning. And one thing to keep in mind too is oftentimes nowadays long-term assets, which would be real estate that would appreciate, for example, is owned inside of an LLC partnership. And there's reasons to do LLC partnerships: asset protection, discounted valuation of minority interests, and so forth. The thing to keep in mind with an LLC interest is, and the assets owned by an LLC, is that the LLC owns the asset. And so when you get a stepped up basis on assets owned by an LLC, technically you're only getting a stepped up basis on the interest in that company, not the underlying asset. Now, your CPA should be reminded to make a 754 election, which would allows the CPA to adjust the basis of the assets inside of the LLC. If that's done properly, the basis on the assets as well as the interest should both step up at the day of death. So when you own that LLC now that your parents have given you, that has that land asset in it, you should be able to, if it's done properly, and both you have a stepped up basis on the value of the outside interest and the inside asset, you should be able to sell that land as the managing member of the LLC and not pay long-term capital gain unless that property has increased in value since the date you received it from your parents. So stepped up cost basis is important to understand as part of your planning, because you'll have to make those decisions. You know, it's like a yin and yang thing. You'll have to make the decision what you're willing to give up for what you're willing to receive. A cost versus benefit, living gift versus gifted at your death.